So we'll go ahead and get started. Thank you all for joining us today. I am Eileen Doherty, and I'm the director of the Colorado Gerontological Society. And so what we're going to talk about today a little bit is joint tenancy versus tenants in common. So the question is, how should you own the property? And really, when you are looking at this question, it's how are you holding the property together? Who all is involved? Is it just you? Is it someone else? Do you have a partner? And then the big question becomes, how do you take title? And when we ask this question, how do you take title? That means what is on the deed, what is on the instruments, if you will, for your stocks or your retirement accounts, your bank accounts, whatever. So for the most part, this session is really going to talk more about real property. And so we're looking primarily at real estate. So this could be your home. It could be any rental properties. It could be a second home, anything that is actual real estate property. Now, in the legal world, in addition to, I personally tend to think of property usually as land or a house or sometimes a car or that kind of thing. Investments then are also in the legal world considered property. So we're looking at stocks, bonds, any kind of exchange traded funds, any of that type of thing is also property. The legal world also calls retirement accounts such as IRAs, 401ks, that kind of thing as property as well. And then they also consider bank accounts, again, because there's cash in either your checking or your savings account. So all of that is, again, considered real property. So as you think about taking title to this property, the first thing when you're dealing with real estate is that you have a deed. Now, there are a number of different types of deeds. There are general warranty deeds, there are quitclaim deeds, there are a variety of other things. The majority of us, when we purchase a house or we purchase investment property, we are looking for a general warranty deed. And what that document basically says is who owns the property, who's in ownership, and whoever is in ownership then also has the ability, if you will, to sell it. When we're looking at taking title to like stocks and bonds, there's often stock certificates or there's an account with like a brokerage firm. So that title, if you will, gets attributed to whose money is it? Now, if it's my money and I'm giving it to my kids, it then becomes their money. So originally it starts out to be my money, but then it moves to their money if I give it to them. And then in the checking and savings account, and also on stocks and bonds, again, it's who's allowed to sell it, who can buy it and who can sell it. So if it's in my name, then I can buy and sell. If it is in my kid's name and I don't have my name on it, then they are the ones who can buy and sell. And then the last thing is that we're going to talk just a little bit about is checking and savings accounts. And again, who could write checks and who can spend the money on that account? So again, that's the title, or that's how the account is titled. For those of you who have just joined us, I made a major error and I created the PowerPoint for the September session as opposed to the August session. So the session we're working with today is entitled Joint Tenancy versus Tenants in Common. I will do the Dying Without a Will and Estates next month in September. And I'm sorry for making that error. So let's get into then joint tenancy. This is when two or more people purchase a property together with an equal interest in the property. So my husband and I own our house, our residence, where we live in joint tenancy, meaning that he has 50% and I have 50%. We have another property in which we own with my grandson, and there are 3 of us, so each of us owns 33 1/3%. Okay, so whoever is entitled under joint tenancy, they, however many total people, that is their percentage. Now, there are 4 conditions that have to be met for something to be titled in joint tenancy. One is that the tenants must all go into title to the property at the same time. So when we took title to the property with our grandson, all 3 people had to be at the closing. All 3 people's names were on the title at the time that we closed on that property. Equal property interest by each tenant. So that's what I meant there. Now, we tend to also use the word tenant when we are thinking about renters. So a renter tends to think about themselves as a tenant. When we are talking about how title is owned with joint tenancy and tenants in common, then we're talking about the owners of the property, not the renters, if it happens to be investment property. So just make sure you understand that while we're using that word, it has, again, a very specific meaning. As I said, all tenants have to acquire the title at the same time on the same document. Now, you might ask the question, what happens if I have a general warranty deed to my house, my husband and I, and we decide that we are going to quitclaim that deed to our children? So all 3 children could then go into title at the same time. So either we could all 5 own it, or my husband and I can take our name off, and then we put their name on a new title. So if we change the title ownership, it all has to happen at the same time. Now, it doesn't mean that we can't do it incrementally. Like 5 years from now, we may decide that if 5 of us own it and one of us wants out or one of us dies, then it might be all 4 of us and we create a new deed. As we said previously, also, everybody who's on the title owns an equal percentage. You cannot separate it out. If there is a joint tenancy agreement, then one of the things that does is it forces then any decisions about the property to have to be made by everyone whose name is on the title. So the kinds of decisions that we might be looking at is when to sell the property. Should we sell now? Should we sell 5 years from now? Should we hold it? Another thing, especially on real estate, is who is responsible for the maintenance and repairs. But this could also be true for your stock portfolio, for example. Who is the person who is going to maintain it? Who is going to receive the statements, who's going to authorize the buy and sell agreements, who's going to file whatever appropriate paperwork is required. And then again, the joint tenancy, the profits from the sale are divided equally. So if I own 50%, I get, and it sells for $1 million, I get 500,000, and my husband is the other property owner, he gets $500,000. If we own this with my kids, and I got 3 kids, and my husband and I, and we sell it for $1 million, then each of us gets 200,000. The advantages of joint tenancy are that it guarantees equal rights and ownership of all parties. So nobody can say you own more than I do, or you have to put in more equity, or you have to put in more cash into this situation, because again, we're all owning it equally. So we all have a similar and equal right. If one of the co-owners dies, then the ownership automatically transfers to the remaining owner and owners. And this is really, really important, especially for couples. If you have a small estate and all you really own is your house, say, you don't have much money in the bank or any of those kinds of things, but you own your own house in joint tenancy, then basically at the point in time where one spouse passes away, the other spouse goes into 100% ownership. You don't have to go to probate. Your heirs would have to go to probate at the time that you pass away, unless you create a new deed, a new title, where you take somebody else into title with you as a joint tenant. And then that would avoid probate a second time. There's no transfer taxes, no inheritance taxes if you own with a child. So taxes basically are also avoided. And then the last thing that's really important is the right of survivorship. So anything that is owned in joint tenancy, whoever passes away first, their share goes to the other joint tenancy. So it survives. The asset survives. It doesn't have to be liquidated or anything. This I find to be often a caution when I am talking to people about bank accounts, because again, the bank account, again, depending on what it is that you're trying to do, a bank account may be in joint tenancy with, say, you and your spouse, but the right of survivorship, that may be your spouse. When your spouse passes away, then it may be for your children or whatever. It's important when you're titling a bank account to make sure that if there is a right of survivorship, and there's some benefits to that, because if you pass away, that bank account, then those funds, if there's a right of survivorship, can be used to pay your funeral expenses or any outstanding bills. So that's an advantage of it. And for some people, that's really important. The disadvantages, and this is a really big one, especially if, as some of us do, have kids that are not necessarily trustworthy. So if you are a joint tenant with somebody and the other person defaults on a debt or a loan, that creditor has the ability to come in, terminate this joint tenancy by basically filing a lien, going into court, and taking your property. So basically, even though you may not have anything to do with that debt or that bad credit situation, you could be liable and they could take your property, and then you would lose all of your assets or your equity in that property. So when taking property in joint tenancy, make sure that you know who the other joint tenants are and whether or not they have any outstanding debt. Again, many of us might do this with our kids, and some kids are going to be more creditworthy and have always paid their bills, and others are going to have outstanding debts. The other thing is that if, like, say, a debt collection agency, say there's you took a house out in joint tenancy with your son, and your son has a long history of not paying his debts, but he thought he paid them all, and he's been doing pretty well, and you're going to take a chance because he's your child, and you're going to buy this house in joint tenancy with him. Let's say that he either denied, forgot, thought it was already taken care of, that there is an old debt that he had, say, from 20 or 25 years ago, thought it was all cleaned up. And these debt collection agencies have an agreement. They get notifications when certain title is changed to property. And now all of a sudden his name shows up as an owner of this house. So that debt collection agency, even though it's been 20 years ago, might come after him. And then you very well might lose that asset. It's not for sure, but it is at risk. A second thing then that's a disadvantage of owning property in joint tenancy is that if you wish to transfer the asset, you wish to take your house and take it from a general warranty deed with you and your husband to your kids, then your husband has to agree because all parties have to sign on that asset, on that title, to transfer it to the new people. And what happens sometimes, not always in marital situations or in family situations, but if you have other property in joint tenancy and the joint tenants cannot agree to do what to do with the property, then they may end up filing a lawsuit to have the courts then determine whether or not the property needs to be sold or whether it needs to be kept. And that sometimes can be very costly and very time consuming. So if you break a joint tenancy, if one of the co-owners transfers or sells their interest to another person, then the ownership agreement has to change to a tenants in common. Now, again, you can go back afterwards and retitle it again, but at the time of the transfer, if somebody sells their interest to someone else, then it changes how the title is, and again, could put you at risk depending on the situation. So, looking at tenants in common, so tenants in common, basically the owners claim a share of the property, but not a specific space. So if you own a house in tenants in common, and your portion is 25%, your spouse's is 25%, and say your son owns the other part of it, then he would own 50%. So while, again, a tenants in common might be a good thing, you cannot separate out your piece. So you can't say to your other tenants in common, you get the bathroom and I get the kitchen, and I'll take one bedroom and you take the other. You basically all have an equal share. Now, you can add new people at any time to the title, and it does not have to all be done at once, as we said on a tenants in common. You can break a tenants in common with one or more co-tenants by buying the other parties out. So years ago, my husband and I were in a business partnership, and there were 3 couples, and one of the couples opted to no longer be a part of the partnership. So the other 2 couples, basically, we just bought that the first couple out, gave them a share of the proceeds, retitled everything, and then basically from that point forward, when the property was sold and distributed among just the 4 of us, then we each just had a 50% ownership as couples. If the property is sold and the proceeds are distributed, what happens then is that it's distributed based on the percentage of your ownership. So again, the 25, 25, 50 arrangement means that if it's sold for $500,000 as 20%, I would get 125, my husband gets 125, and if our son is the third party, he gets 250. Now, when you go to court, if you have to go to court, there's a partition action. Again, you will either, I wouldn't advise necessarily doing this yourself. Probably need legal counsel, or at least a lot more support than I'm going to be able to offer you in this conversation. But basically, a partition action is filed with the court, and that allows someone to break or sever the tenants in common. And then the ownership can either continue as tenants in common, or you can change it after the petition has been filed and the decision has been made and the breakup or whatever has happened. So when you have tenants in common, you have a right of survivorship. And one or more of the owners die, the tenants in common have no right of survivorship. So in joint tenancy, my husband and I own the house together. He dies, I own the whole thing 100%. If he and I own our house as tenants in common and he dies, and if he has a will or a trust, then his portion basically goes to his will divides it, and his will may say, I get it as his wife, or his will or the trust may say that someone else gets it. But basically, his portion is going to belong to the estate, and then based on what's in the estate or the will or the trust will depend on who the new tenant in common is. The advantages of tenants in common is that each owner does not need an equal share. And for some people, for some transactions, again, that's very important. If the individual does not want to share their share to transfer to the other owners, but wants to designate who gets their share upon their death, again, as we just said, that can easily be accomplished by the designating that through a will. The disadvantages are if you do not have a will and you hold title via tenants in common, then your share is going to be distributed according to Colorado probate laws. So it's important to have a will. And as I said, we'll cover that next time. Co-owners can sell their portion without your say. So it's possible that if I have a 50% share in a house and I don't want my share anymore, or I need the money, then I can just sell out from underneath you or underneath my kid or whatever, my 50%. You then could end up with a new owner as the other tenant in common, and you may or may not know that individual. So there is some risk to owning property as tenants in common because there does not have to be consensus, if you will, about when you sell your portion. So changing or ending the co-ownership is going to be much easier if it's a voluntary situation. And then the co-owners sell the property and divide it, or one or more of the owners buy the others out. If an agreement cannot be reached, then as we said, you can take legal action. It can then be sold under court supervision, and then the proceeds are divided however the court deems or determines or rules. What we see in that situation frequently is that it's very expensive, and that usually those charges, if you will, become a cost of the property owners, and that reduces then the equity or the amount of proceeds that are distributed or available for distribution. So in summary, the 5 kind of things that we've talked about as we compare joint tenancy and tenants in common is that when is it created? Joint tenancy at purchase, tenants in common anytime. The number of owners can be 2 or more in both situations. The degree of ownership has to be equal in joint tenancy, but unequal in tenants in common. In joint tenancy, we have the right of survivorship. In tenants in common, the owners can pass on their property to anyone upon their death, assuming they have a will or a trust. And is probate necessary? On joint tenancy, usually not. In tenants in common, again, depends what it is, what the size of the estate is, what kind of property is being transferred. So if it's a checking account with $100, probate's probably not going to be necessary. If it's $1 million home and you own it in tenants in common, you will have to probate it. So with that, that brings our comments on the joint tenancy versus tenants in common to a close. I just make a few comments about a few of our programs. We did get new money to provide dental services for older adults July 1. And so there is money available if you live in Metro Denver or anywhere on the western slope east of I-25, all the way up to the Wyoming border, and east of I-25 except Pueblo and Colorado Springs, all the way down to the New Mexico border. We also still are doing our advanced care planning, and we'll be doing the holiday baskets in the fall. Our 2 big programs that we're working on right now is our Salute to Seniors will be on August the 23rd. It will be at the Greek Event Center in Denver at 4610 East Alameda. Starts at 9:30 in the morning and ends at 3. There's a full day of events, and you can check our website for those. The other thing that we're working on at the moment is housing advocacy, and this is a program Many of you may have already seen it, where it's the senior housing income tax credit. If your annual income from all sources is less than $2,000 or $25,000, you may be eligible to up to $800 in an income tax credit, which would come to you as cash if you do not own Colorado income tax. If you have between $25,000 and $75,000, again, you would get a prorated amount, and that might come to you as a cash check, or it may come to you as a reduction in the amount of Colorado income tax that you owe. You also, to take advantage of that, cannot be taking part in the senior property tax homestead exemption. The other thing that we will be doing later in the fall is our Medicare Monday series. We primarily have the sessions, or have started to schedule them, in the Metro Denver area, and we'll be scheduling outstate soon. And with that, I will close today's presentation. Thank you all for attending.